Hi friends, very recently I was reading this news article which said that SIP stoppage ratio hits all-time record high of 122% in February month. So what is this SIP stoppage ratio? It simply means number of inactive SIP accounts divided by number of active SIP accounts multiply by 100. So essentially what has happened in the month of February 2025 is that number of active accounts were only 44 lakhs while number of inactive or discontinued SIP account rose to 54 lakhs. So if you divide 54 lakhs by 44 lakhs, this ratio comes out to be 122%. Simply put, for every 100 SIP active accounts, there were 122 inactive SIP accounts, and the bottom line is that a lot of people have stopped doing their SIPs in the month of February 2025, and you and me exactly know why that is happening, because since September 2024 Indian stock market has been correcting, it has been falling, and a lot of people have exited Indian stock market from a SIP's point of view in the month of February 2025. But here is even more interesting data point for you. If you go to AMFI's website, what you will note is that you can go back and calculate this SIP stoppage ratio for the last 12 months or so. For example, here, have a look at the July 2024 data. So if you see this column here, which is 37 lakh accounts, is the number of SIP discontinued accounts. And if you see 72 lakh here, that is the figure which is number of new SIPs registered. So if you look at 37 divided by 72, your SIP stoppage ratio comes out to be around 50%. Meaning that in the month of July 2024, the SIP stoppage ratio was at the lowest. That means in the month of July 2024, a lot of investors were actually opening new SIP accounts, and a very minimum SIP investors were closing their accounts or had inactivated SIP accounts. And I was wondering what was so special about the month of July 2024, and what I found was something mind-boggling. Have a look at my screen, you will see that in the month of June 2024, Nifty had gone up by 6.57%, which is the biggest monthly gain of 2024. And as soon as in the month of June, Nifty gave 6.57% positive returns, guess what happened? Investors started to flock the market, and in the month of July 2024, the SIP stoppage ratio hit the lowest, meaning a lot of people were doing SIPs in the month of July 2024. This is simply telling us that a lot of investors are chasing the past returns. If the market goes up, all of a sudden everybody start to become bullish about market. They start to throw money into the market as if there is no tomorrow. And when the market start to correct, which has happened since September 2024, what happens is that investors get very, very fearful. They start to withdraw the money from SIPs or stop their SIPs as if there is no tomorrow. Now the billion-dollar question you may have is that, Rahul, what should we do right now when so many people have stopped doing their SIPs? Should we also stop doing SIPs? So in the next 4 to 5 minutes, I'm going to run you through some mind-boggling data analysis that will tell you a picture. I am not going to give you my opinion. Let the data talk. Let the data paint a picture for you. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. With that, let's get this video cracking. The first data point is from a company called White Oak. Have a look at my screen, and again this is showing you the BSE Sensex returns for almost last 28 years from September 1996 to December 2024. So this is a very, very long duration data, 28 years of data, and this is important because it removes all the market cyclicity and gives us plain picture that we need to really look at. So the first point here is that you see on the top here 3 years, 5 years, 8 years and so on and so forth, meaning that if an investor did the SIP for 3 years, and there may be a lot of multiple 3 years durations between this 28 years of time period, but if somebody did 3 years of SIP investments, the maximum return that somebody would have generated is 52.4%, minimum is loss of 36%. Now both these cases are edge cases. This is because for somebody to generate 52.4% yearly returns for 3 consecutive years is going to take extreme perfection in terms of the market cycles, market conditions and many other things. So these are very edge cases. But if you look at the average return for 3 years duration, this comes out to be 13% yearly returns. Now those people who are right now sitting in losses for their SIPs, I need to ask them this question. How long have you been doing your SIPs for? I can bet it that you have not completed 3 years of your SIP investment, and that's why you are sitting in losses. And let me now prove this statement by some another data point. Have a look at my screen and you will see that if you started doing SIPs from 1st of January 2021 and you continued up until 11th Feb 2025, so total 50 months of SIP investment in the large cap category would have yielded around 13.4% CAGR return, which is yearly returns, or rather XIRR returns, mid cap 19.7 and small cap 20.6. Now, if you look at this chart here, you will note, if you come down to the bottom here, that 1st of July 2023, if you started your SIPs, which is around 20 months of SIP, even if you did 20 months of SIP up until 11th of February 2025, you would still be sitting in profits, 8.2% in the large cap, mid cap 11.4 and small cap 8.5. Again, these are some average returns. It really also depends on which mutual fund you might have picked up. And if you've picked up a really wrong mutual fund, I can't speak for you. Again, very limited chances here. But if I continue to show you the data here, it's only those people who started doing SIP from 1st of January 2024, they have been starting to make losses. And the problem with these sort of investors is that they are going to say that, hey, I've been doing SIP for last 1 year now. And in fact, rather than making any money, I am now sitting in losses. You know what? The SIP is a crap. SIP is not sahi hai. SIP is bad. Let's exit stock market. That's the feedback you will get from people because they have not really done 3 years of minimum SIP in the market. That's what the data is telling me, and therefore I am fully convinced that if somebody has remained invested and have continued their SIPs for minimum 3 years of time period, 99% chances are there that they are in profit. I can't speak for that 1% person, for whatever reason they've picked up a bad mutual fund or whatever, have gone into losses. Now you may say that, Rahul, does it mean that if we have to do SIP, we have to continue our SIP for minimum 3 years? Well, what I would say on that is, again, have a look at this chart back here and you will see that if you do 3 years of minimum SIP duration, the past data of 28 years is telling us that 80% times people have got positive returns, right? 60% times they've got more than 8% returns, and 58% times they've got more than 10% returns, 52% times they've got more than 12% returns. Now, whether 3 years is a minimum SIP duration that you need to stick with is your call that you have to take. But if I were to make a decision here, I would say 8 years of continuous SIP investment makes a lot of sense in my head. Why? Because if you see 100% times people have got positive returns. So you will not make losses. If you remain invested, continue to do your SIPs for 8 years, no matter if there is a tsunami in the world, no matter what is happening in the stock market, you continue to do your SIP for 8 years of duration. 100% times positive returns is what we have seen in the last 28 years. Now, I'm not saying that future cannot be different. Of course, future can be different, but we have no reference for a future point. We have reference for past, and that's the best we can use to make some good decisions. Also, if you continue to do SIP for 8 years continuously, then 94% times you are likely to get more than 8% returns. That's what past is telling us. And getting more than 8% returns simply tells us that we are able to beat FDs, bonds, fixed income instruments. And guess what? We need at least that much of alpha because we are taking more risk in mutual fund SIPs versus fixed income instruments like bonds and FDs. By the way, on bonds, I had very recently created a separate full video on bonds explaining you ABC of the corporate bonds. If you have not yet watched it, please go and watch that video. You are going to learn a lot. So coming back to this analysis here, if you continue to do 8 years of SIP, then there are 82% times you have generated more than 10% returns if you look at the last 28 years of data. My point is very simple. Longer you remain invested in SIPs, better chances for you to not lose money, and in fact, better chances for you to generate more than 8%, 10%, 12% returns is what the past data is telling me. Now, you may have a counter argument to me that, Rahul, what if that I do not want to invest for 8 years or 10 years? I want to only invest for 2 years. What do I do? My humble request will be go and invest in FDs and bonds. They are much more stable instruments and do not chase returns which are as high as 12%. Yes, the only point I would make is that if you are right now able to save, let's say 10,000 rupees per month, and out of that 10,000 rupees per month, you can see that at least 2,000 rupees per month you can allocate for your 10 years, 15 years of time horizon, then that 2,000 rupees becomes eligible for mutual fund SIPs. That's how you really need to think about mutual fund SIPs. The second question you may have to me is that, Rahul, right now my mutual fund portfolio is in negative. I've been doing SIP from the last 1 to 2 years, and you can see I'm down by 10%, 15%, 20% and whatnot. I'm panicking right now. What do I do? The only thing I need to tell you is that let me show you some data, some mind-boggling data. You just need to have patience. See this chart. This chart is showing you almost 19 years of data from August 2001 to December 2019. So this chart is showing us the first 5 years SIP returns of multiple investors. And now let me simplify this. You see the flat line here, which is 8%. So if an investor during the first 5 years of their SIP investments generated less than 8%, those investors are marked in green color here. So for example, here during this dot-com bubble, a lot of people's portfolios were down and their first 5-year returns from SIPs were less than 8%. Again, here during the financial collapse, you see the blue line going down the 8% mark, meaning that a lot of investors' first 5-year returns in SIP was less than 8%, so on and so forth. Now, what happened to these investors is a very, very interesting story. If these investors continue to remain investors and continue to do their SIPs, if you look at their 10 years SIP duration, so if I show you this data here, you will note that those investors that were in green, if they continue to do SIP investments for 10-year horizon, their 10-year horizon actually gave better returns. So they generated 18.7% returns versus those people who were in blue, meaning that for those blue people, their first 5-year SIP returns were higher than 8% mark. For them, the eventual 10-year SIP investments came out to be only 14.9%. And why does that happen? Just hypothetically understand one point here. Let's say that you start to invest here at 0 and after 10 years you want to see your portfolio or your corpus. Now the first 5 years, if you are in losses, meaning that you are building a base. Let's say you build a base in the first 5 years. What happens is then after 5 years, because the market will recover at some point in time, and if you have been down for the first 5 years, when the market recovers, you've already built a base wealth here. And even if now after 5 years market moves by 2%, your 2% will get applied to a huge base value, and therefore your overall portfolio growth will be much higher. And that's the concept that you really need to understand, that even if right now markets are falling or whenever in the future markets are falling, it doesn't mean you stop doing your SIPs. In fact, wait for 10 years to play out if you're playing a SIP game. Don't expect your SIPs to give you 20% returns by only doing investment for 1 to 2 years. I hope this data analysis is very, very clear to you. And if you like this analysis, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Also, you can consider joining my YouTube community. I post almost on a daily basis a lot about Indian stock market, mutual funds, ETFs, various assets, and I bring you these insights for you to practically learn what's happening in the market. The feedback of this community has been excellent. Simply go to my channel, find the join button and be my guest. The third analysis that I want to present to you is that which market segment has given the highest SIP returns if you look back the data. So here is 10-year monthly rolling data for almost last 20 years. And you will clearly note here is that Nifty Midcap 150 has given better SIP returns than Nifty 100 and Nifty Small Cap 250. If we are considering 10-year monthly rolling return data, please understand the word here, 10-year. For 8-year, it might be different. For 6-year, it might be different. So depending on your time horizon, it might be very, very different. And also please understand that past data does not guarantee that in future also mid-cap will continue to do this. It may be possible, it may not be possible. The only reference point we have is the past data. So I am literally telling you what has happened in the past, which is the mid-cap has beaten small cap and large cap, both with huge margins. So if you look at the average returns here, 17.3% versus 12.9% in large, and small cap is 14.6%. Mind you, 4%, 5% return, extra return over 10 years of period is a huge difference to your portfolio. So please make sure that you understand these nuances. But overall, Nifty Midcap has done very, very good. In my view, you don't need to go all after mid-cap. You really need to look at diversification. I continue to speak about diversification because your goal may not be what mid-cap has performed in the last 10 years. And also future may be very, very different. So always go for diverse mutual funds. So let me in the next few minutes run you through the best performing SIP mutual funds in every category in the last 10 years. I'm going to take quick 2 to 3 minutes to run you through this analysis. Very, very important. Stay tuned. Let me go through that now. So in the large cap category, if you look at the last 10 years and if you look at the direct mutual funds and if you look at the SIP returns, Nippon India Large Cap Direct Fund has given the best SIP returns in the last 10 years, 17.13%. By the way, none of these are recommendations. My point is to give you some reference data from past so that you can make possibly better decisions. At number 2 is ICICI Pru at 16.52. Neck-to-neck competition between ICICI Pru and Canara Robeco, which is at 16.41, followed by Baroda PNB Paribas and Edelweiss Large Cap Direct Fund at 15.56%. So these are the top 5 mutual funds from a SIP perspective in the last 10 years in large cap category. If you look at the large and mid cap category, There is a neck-to-neck competition in the first 4 mutual funds here. ICICI Pru, Quant, Bandhan Core and Invesco India, all of them have given more than 18% returns. These are all XIR returns. All of these 4 have performed really good in the last 10 years, followed by DSP equity at 17.93. So these are the 5 best performing mutual funds in terms of SIP over a last 10 years of period. If you look at the mid cap category, there are 3 mutual funds that have generated more than 22% yearly returns. One is Motilal Oswal, followed by Quant, and then second is Baroda BNP Paribas. All these 3 have given more than 22% return. And after these 3 mutual funds comes Edelweiss, Nippon India, Invesco. All of them have generated more than 21% yearly returns when it comes to the mid cap category for the last 10 years. What about small cap mutual fund category? If you look at the last 10 years XIR returns, Quant small cap is a clear winner at 25.05% returns, followed by Nippon India at 23.41, followed by Axis and Kotak, which is at 21.48 and 20.39 respectively. Moving on to multi-cap category, Quant Active Fund has generated 20.25% returns in the last 10 years, followed by Nippon India at 18.93, and at number 3 is ICICI Pru at 17.41% returns, followed by Baroda Multicap and Invesco Multicap. All of them have given very similar 17% sort of a return. Next in my list is Flexi Cap mutual funds, and when it comes to Flexi Cap, top 3 are Quant, followed by Parag Parikh, and then JM Flexi Cap. I did a full video on stock investment approach by Parag Parikh Flexi Cap. That video is still out there. Please go and watch that. You're going to learn about what stocks they have added, what they have removed in the recent correction. Very, very good learning for stock investors as well. But anyways, Quant, Parag Parikh, JM Flexi, these are the top 3 performing Flexi Cap mutual funds in the last 10 years from a SIP perspective. Last category, which in my view is a dying mutual fund category, ELSS category, only has relevant for people who are in old tax regime. But if you look at the data here, Quant ELSS is a clear winner, 22.45% in the last 10 years, followed by Motilal Oswal at 18.7%, and then at number 3 is Bank of India ELSS at 18.63%. In fact, if you look at Motilal, Bank of India, DSP and SBI, all of them have given slightly more than 18% return. So a neck-to-neck competition when it comes to ELSS category. So in this video, I've shared a lot of analysis with you, and I hope if you are in losses, it would have calmed down your nerves. And if you're not in losses, if you're in profits, it would have given you a direction in terms of SIPs. Never look at them in terms of short term. Never try to do the market cycle. Never try to time your entry and exit from a SIP mutual funds perspective. Remain invested for as long as possible, 8 years, 10 years, 15 years. Again, of course, depend on your time horizon. But hopefully this data has made you a much more educated investor. And that's the intent with which I bring these videos to you. If you like this video, request you to hit the like button. Let me know in the comments a simple thank you. And also, if you want to practically learn investments, you can join my YouTube community. The feedback has been excellent. With that, I will see you in my next video. Until then, keep rocking.